increased disclosure. That's all. The best available information takes account of all information about market participant assumptions that is reasonably available to the entity. So what are they trying to say at the end there? Even though you might not have access to an active market, wherever you do see that there's something that you can corroborate with the market, even though it relates to your internal data, use that as far as possible. Look at the assumptions that the market participants would have made when doing their calculations of fair value and make the same assumptions, although the market information is not available. The underlying assumptions could be, and that is why it's so important for you to provide the disclosure, because then you're going to tell the user, these are my assumptions, these are my judgments, now you can decide whether you agree with them or not, and in that way we increase transparency. Ladies and gentlemen, in our second last chapter on IFRS 13, it is important that we look at the fair value measurement process. All right, and then in the last chapter, chapter 5, we're going to look at the actual disclosure requirements according to the different levels, according to which your inputs for fair value were determined. All right, so if we move on to slide 18, you can see the ultimate goal when we measure fair value is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability would take place between market participants at the measurement date under current market conditions. I think we need to read that again. We need to estimate the price at which an orderly transaction, what does that mean? A formal transaction, not just, it's above the board, it's a proper transaction on a market, or between participants. I still think about that whole thing about highly knowledgeable or willing parties, in an arm's length transaction. I still let that knowledge stay embodied in my head when I read an orderly transaction. But anyway, to estimate the price at which an orderly transaction to sell the asset or to transfer or settle the liability would take place between market participants. Do you see that? Market participants, that implies that there's no arm's length transaction problem. All right, so it's not between a parent and a subsidiary, it's between market participants in an arm's length transaction. That is implied at the measurement date under current market conditions. All right, so we are taking market conditions into account, we're taking those assumptions into account, and that's how we determine fair value. All right. The fair value measurement process is as follows, and you can highlight this. This is important. This is how you need to go about finding the correct fair value. We determine the particular asset or liability that is the subject of the fair value measurement consistently with its unit of account. Okay? So we need to firstly properly decide what asset or what liability must be measured. Secondly, for a non-financial asset, very important. For example, inventory, PPE, intangibles. We've spoken about this in the previous chapter. Determine the valuation premise that is appropriate for the measurement, consistently with its highest and best use. So we're going to say, perform a valuation basis. On what basis are we going to, determine this fair value in such a way that we give the benefit of the doubt to this non-financial asset? So with its highest and best use. We're not going worst case scenario, all right? Then we determine the principal and most advantageous markets for the asset or liability. Why do you think we determine both? Because if the principal is not there, then we will use the most advantageous market. Determine the valuation techniques appropriate for the measurement, considering the availability of data with which to develop inputs that represent the assumptions that market participants would use when pricing the asset or liability, and the level of the fair value hierarchy within which the inputs are categorized. So can you see the process? Find the asset or liability that you want to measure at fair value. If it's a non-financial asset, make sure that the basis that you're going to use, the valuation method that you're going to use, is based on the highest and best use of that asset to have the highest possible outcome as the fair value of that asset. Then determine the principal and most advantageous markets, and then look at your valuation techniques and make sure that the inputs in those valuation techniques, Where do they actually come from? From what level? Identical in an active market, or are they similar in an active market, or are they identical in a non-active market, or a very low volume of transactions that are taking place in that market, or are they just coming from internal inputs from within the company? So basically we are getting everything ready for the valuation process in this case. All right, so that is very important that you look at those inputs. If you look at an option pricing model, for example, okay, what do we know is the fair value of an option? It equals the intrinsic value plus the time value. Do you agree? So you normally use the binomial or the Black-Scholes model to do option valuations. So when you see I've got an option to value, then my valuation technique is either going to be binomial or the Black-Scholes model. What are the inputs? I'll need market prices for the shares. Where do I get them? The identical shares in an active market. My shares are highly traded, so the inputs for that is going to be, or are going to be, level 1 inputs with a very low level of disclosure. So that's the way that we go about doing this kind of thing. All right, so as you determine the inputs for your valuation techniques, remember to determine what level they will actually be sourced from. All right, slide number 20, measurement guidance. Take the same characteristics of assets and liabilities into account that a market participant would take into account when pricing the asset or liability at the measurement date. So you've got to look at things like condition, location, restrictions on use or sale, etc. So all that they're trying to say is don't function in your own little vacuum here. Okay? You've got to ask yourself, what would the assumptions be that the market participants would take into account, and as far as possible apply the same assumptions to the valuation that you're busy performing. An orderly transaction is assumed between market participants at the measurement date under current market conditions for fair value measurement. That is what we spoke about earlier. Current market conditions. Now, the fair value that is determined with reference to what the parent will buy the asset for from the subsidiary, that's not a current market condition. Do you agree? And therefore, we are going to not, rate that as an orderly transaction. So when you think about an orderly transaction, ladies and gentlemen, it's still important that you still think about a transaction between knowledgeable and willing parties in an arm's length transaction. All right, so the amount that it would be exchanged, think about that in the background when you think about an orderly transaction. All right, such transaction takes place in the principal market for the asset and liability, or in the absence thereof, the most advantageous market for the asset and liability. And this is what we've discussed before. For non-financial assets, take into account the highest and best use. We've already emphasized that. And fair value of a liability reflects non-performance risk, including the entity's own credit risk, assuming the same non-performance risk before and after the transfer of the liability. All right, so what we are saying here is that when you determine the fair value of a liability, you must also go and work into that fair value the entity's own non-performance risk. Just think about how sensitive this information is, because I'm sitting with a liability on my statement of financial position, and now I'm working into its fair value. The fact that there's a non-performance risk on my side, okay? The fact that the entity's own credit risk, the fact that I might not settle the liability, all right? So that information is quite sensitive, and you can see all of this is done in the name of increasing transparency so that we can increase the usefulness of the financial statements. All right. Slide number 21, valuation techniques. What's the guidance that is given here? It must be appropriate in the circumstances. Now, this is not a financial accounting issue. This is a management accounting and finance issue. So there you must go and decide, should I do, what kind of valuation should I do? Free cash flow, net asset value, etc. All the valuation methods that you get from there. And then decide which one is most appropriate for the type of asset that I'm valuing. Sufficient data must be available, maximum observable and minimum unobservable data and inputs. And I think there we understand why that is the case. 3 common valuation techniques are used: the market approach, the cost approach, and the income approach. Let's just quickly have a look at them. Market approach, prices and information are generated by market transactions for identical or similar assets or liabilities. I think that's the preferable one. Do you agree? Why do you think that's preferable in terms of IFRS 13? Because it comes from a market. It's not manipulable, it is independent, it is not, it's objective, not subjective, etc. And it can be verified. Do you agree? Cost approach, the amount that would currently be required to replace the service capacity of an asset. So look at that second one. If you look at property, plant and equipment, what are they saying here? The first option when you do a revaluation is to revalue to fair value, which is market value. All right? The second one, and this is the one that is unfortunately examined the most, but that isn't really that useful for practice, is your net replacement value. Can you remember your net replacement value from IAS 16? What happens there? You take your cost price for a similar asset that is new, and you basically age the cost price to the same age as what your asset is now. So you're comparing it to technically the aged cost price of a new asset. When you compare the two, which one do you think is best? Market value, without a doubt, level 1. But at least now that cost price of a new one comes from a market. We know what the selling price is of a similar asset. So at least it is observable data. And that's why that will go into level 2. But that already shows you that the net replacement value method is not, or replacement value in general, is not a very good method. But that is only used in the absence of market value for that particular asset. All right. And then income approach, future cash flows are converted to a single current discounted amount reflecting market expectations. I think you all are comfortable with doing budgets and planning ahead and discounting to a net present value. Your NPV calculations that you do in management accounting and finance, those are the things that they're referring to here. So ladies and gentlemen, what's the issue here? What is the observable data? There isn't a lot of observable data, because you're going to have to say this asset, I estimate, is going to produce so much future economic benefit. I suppose, you can go to the market and look at other assets as well. Similar assets, maybe even identical assets. So maybe I shouldn't generalize by saying that is not good. All right, but when it starts moving to this is based on management's estimate of the future cash flows out of this asset, then it starts getting dangerous, because then effectively it's based on internal data that isn't really observable. So when you decide between category 1, 2, and 3, or level 1, 2, and 3, what must you ask yourself? How observable is this data? And the more observable it is, the better. Then it also says at the bottom of slide number 21, single or multiple valuation techniques may be appropriate. So you're going to have to find the most appropriate valuation technique and then make sure that you do a proper fair value measurement for that particular asset or liability. Ladies and gentlemen, in the last chapter on IFRS 13, I would just like to show you what the disclosure requirements are. And I haven't listed all the detailed disclosure requirements because that document is available on our website, www.caacademy.co.za. And you can just link in under or log in under education and then scroll right to the bottom, and that's where you'll find a summary of the information that needs to be presented, or disclosed rather, regarding fair value measurement. So I don't want to bore you with all the tedious detail, so we can just go on and look at the classes of disclosure required in terms of IFRS 13. If we move on to slide 23, why do we have this disclosure? The disclosure requirements try to enable users of financial statements to assess for assets and liabilities measured at fair value on a recurring or non-recurring basis in the statement of financial position after initial recognition, the valuation techniques and